Hello, good morning. It's Thursday, October 18th. We've had a few changes overnight. We're seeing investor confidence once again being challenged. We had a report out yesterday from the FOMC, and that did trigger some nervousness. We'll just come to that, but I think just on the first slide, I'm just going to highlight once again, as we did yesterday, that our quarterly outlook came out yesterday. It's basically with the title "Emerging or Submerging Markets." You can find that on the link I put up there, home.saxo traders market analysis. So take a look at that. We got input from all our strategists around the world. So that's something you can take a look at. Yes, as I mentioned, we had the FOMC minutes out yesterday, and the result was basically the stock market started to weaken. We saw the dollar strengthen a bit. US 10-year bond yields is back above 320, as we can see on the chart here. Basically, what the FOMC said was that they are prepared to continue to raise rates towards neutral and potentially even beyond, and that is creating some nervousness in the market. So even though we've had some solid earnings here recently, the market is still really focusing on some of these outside developments, which is creating some nervousness in the market. Not least the report from the U.S. Treasury that they decided not to state or claim that China was a currency manipulator. It has had some movements, triggered some movements in the market overnight, and as you can see here on the chart, the Chinese renminbi, which is the onshore CNY, overnight has dropped to the lowest since January 2017. There has been some speculation that the Chinese central bank may have kept the rate stable ahead of this report that came out yesterday. And now afterwards, the market is weakening once again. And it does indicate that once again, this $7 focus is coming into play. And I got Mathias here, our FX trader, with us today, and because clearly there's something going on here, and you can give us just a rundown on what's happening in the option market, because it looks like we have this very interesting barrier just waiting above here.
Yeah, exactly. So if you can look at the next chart, we can see that we're getting up at close to 7 in dollar CNH, which is the one that we can trade. While the black line here in the chart shows the 1 month's implied volatility, which is going lower now over the last week. So we see a small pickup in the vols today. But there's a lot of talk about what will happen at 7. Will China protect the barrier at 7.0? And that's what the market thinks, at least. And there's talk a lot of barriers at 7 or just above 7. So this gives the market a lot of gamma.
Yeah.
That's why the front end volatility is relatively low at the moment.
And I suppose that basically means that if we should break 7, then there would be quite a lot of covering that needs to take place, and that could suddenly mean that we potentially have an extension.
Yeah, exactly. So, I mean, if you just look at the market position at the moment, I mean, we can see a slow grind higher up to 7. And if 7 then goes, then we can see quite a sharp move higher when there's going to be quite a few stops going at 7 and just about 7. So we've seen, while the front end of the curve is relative offered at the moment, we see a lot of buying on back end, like 6 months to 1 year, and especially low delta calls.
Okay, and we can also see some of the other markets overnight in China. We've seen the CSI is down to a new fresh 4-year low, and we've seen something like copper prices coming under pressure. There's also been some additional move from the Trump administration with regards to the trade war. They're going to basically remove some discounts they had on postal shippings to the US, and that's the next stage in this war. So China is under pressure at this stage. Another market that potentially could be under a little bit of pressure here, if you look at the chart, is gold, because we have been in recent weeks talking a lot about this very strong correlation between gold and the Chinese renminbi, and we saw that break higher last week, and this comes after a period where we have seen the renminbi trade quite steady. So right now, with the US bond yields moving up again, with the Chinese renminbi weakening, it's really only the stock market's nervousness that's providing some support. So as Mathias mentioned, if we are going to see the Chinese renminbi weakens above 7, then gold may be struggling here to get enough of a bit to move up towards the next really big level, which is 1240. So 1210 remains the key support, but just look out for that one today. We could potentially see some weakness come into the gold market. Staying with moving back to currencies, because we saw another EU summit yesterday resulting in nothing, and So basically, we're back to once again focus on Brexit. What's the news there, you would say?
Yeah, so after the EU summit now, we have more or less ruled out a November meeting. So focus is now turning back to December meeting. So if you look at the charts, we can see that there's still a lot of concern for if we're going to get the hard Brexit or if we're actually going to get the deal. So the top of the chart shows the 3 months risk reversal, which still trades extremely bid for sterling puts. So there's a big demand for hedging a no-deal Brexit. And now when we ruled out the November meeting, all the focus is now on the 2-3 months. So in the second bottom half of the chart, we can see that the 1 month, which is the black line, has dropped significantly over the last 2 days, while 3 months is still trading at the highs.
That's interesting. I think staying with Europe, we have more problems there brewing. We saw yesterday that the Italian budget was sent to the EU, and basically they more or less responded back straight away that it was likely to be rejected. So the Italian bond spread over German bonds has risen back above 3. It's hitting around 3.1% right now. It's the highest in more than 5 years. So we are not out of the woods yet in regards to Italy. So that's also adding some downside pressure to the euro this morning, on top of the dollar strength we saw yesterday. With these more uncertainties we're seeing stock markets weakening last week. We are seeing the bonds moving higher. Currency markets are not really going anywhere overall when you look at all the uncertainties that's out there. And I think you brought a nice chart which reflects that.
Yeah, that's correct. I mean, spot is not doing anything, and but the market is really concerned about the current environment. And in this chart, we see just the currency VIX. And the black line is then the 1 month implied volatility, which we can see trades a lot higher than the realized, which is the blue line. So spot is not moving, and we have the realized FX vols are basically at the year low, while we're pricing in something's going to happen. But
so basically, what you're saying is traders they're looking for an event, and they're prepared to pay up for in volatility to protect them against it, but it's just simply not happening. So that's why when it comes to what has been realized, it's still very low.
Yeah, of course. I mean, we have a huge risk premium in sterling, but we also have a lot in yen vols, for example. Now with the equity market is struggling, and we have the trade wars and everything. So sterling and yen vols, that's the ones that are the most overpriced at the moment.
Okay, thank you very much, Mathias. Let's just move to a couple of events elsewhere in the commodity space. We've been talking about this return to $80, and we saw that again yesterday. We had the inventory report out, which showed us a price jump, and oil price sold off. But if you look at the chart, we are still just hovering around this $80 level. I put out a report yesterday on home.saxo you can read. It's basically just highlighting this tug of war we have right now between those worried about sanctions on Iran and the impact on supplies, but also the other camp which seems to have been gaining some momentum recently. Those who are looking for this slowdown in global growth, which eventually could have an impact on crude oil demand. So right now we are stuck at this 80 level. Looking at the position in the market, the short-term risk potentially could point to some weakness. But I think as long as we have the uncertainty related to Iran and we don't know the full impact, then I think there will be some underlying support coming in. So if we see a move below 80 here on some long liquidation, I think there will be buyers prepared to step in at that stage. Just staying with the energy, just before we move to the calendar, natural gas we don't talk about that much, but if you look at the chart here, we are actually seeing the price picking up, and it's been holding above 3 now for a while. What's going on there is you can see on the right hand side, we're basically running out of time to fill the storage, underground storage facilities in the US. Right now it's trailing the 5-year average by around 17%. It basically means that if we should see a very cold winter in the US, then the gas levels could potentially create some uncertainty and thereby drive the price even higher. So that's what's providing the support, that the fact that we are running out of time to fill up these storages. We have a weekly report out this afternoon, and that tends to create a bit of volatility because that's the weekly storage change report, just highlighting how much was put into storage the previous week. So if it diverges from expectation, we could see some movements there. But that's the overall story in natural gas. Finally, let's just move to the calendar today. It's relatively thin. We got UK retail sales coming up here at 8:30 GMT. We got October Philly Fed this afternoon from the US, and then, as I mentioned, at 2:30 GMT we got the inventory change. So when we come out of this week, I think the focus will really start to hone in on the early November events where we got the US midterm election. That's going to attract a lot of attention as we get increasingly close. That's it from us. Thank you very much for joining, and we'll be back again tomorrow.